today, what I'm going to do is I'm going to use the stochastic calculus that we developed last week to develop the Black-Scholes theory, which is what will allow us to do option pricing in continuous time. It's a beautiful theory. It's a wonderful theory. It got the Nobel Prize to Merton and Scholes. It got many jobs to many people like you in years past. It's something that everybody's required to know these days. It's just basic knowledge. But it's no longer something that knowing it will get you a job. That used to be the case. It's no longer the case, okay? But it's something that you still need to know. It is, it'll be weird if you take a course like this one and then you don't know the Black-Scholes theory. So we're going to do that. You will see that it's beautiful, but also we're going to learn some things from it. And some of the things that we'll learn from it today are still very difficult and still very much required in job interviews when you go there. So it's not the plain vanilla theory is something that everybody has to know, but there will be some implications of that which are very interesting, and I'll discuss today. But I'm going to start. I want to start from the beginning, which is today is going to be my last lecture on option pricing. After all this time, we'll be doing option pricing this way, that way, linear algebra, fundamental theorem, continuous time. It's my last one. So I'm going to spend a little bit of time talking about what we actually do in pricing theory. What is this good for? So we're going to see what it is that we can do here. All right. What happens here? All right. So I want to talk about financial instruments. There is financial instruments of different types. Usually the financial instruments are divided into assets or traded instruments like stocks and bonds, futures, and derivatives. Assets and derivatives. Derivatives need a reference asset, an underlying asset. That's why they're called derivatives. And those assets could be equities, bonds, currencies, other things. The ones that we have been doing mostly in this course are directly applicable to equities, but today we'll mention a little bit about fixed income derivatives. I'm not going to develop them systematically, but today they're going to show up side by side with equity derivatives. And the reason is that from a financial perspective, they serve exactly the same purpose, although mathematically they may be very different. And we're going to do all of this today from the perspective of continuous time pricing. Discrete, we already saw. You build your trees, propagate them. You may have to factor in some decision making like American options or swing options. And in the case of continuous time pricing, we're going to end up with closed form solutions. Closed form solutions are a big deal in finance, not because they are pretty, which they are, but also because they're fast. And sometimes you have to do, for example, simulation, you have to simulate, say, 1 million scenarios. To do 1 million integrals is one thing, to do 1 million trees is a different thing. So something and also we're going to have, the fact that we have a direct algebraic expression will help us understand things that today will be important, such as sensitivities and so on and so forth. Okay. Today's lecture is actually best combined with the corresponding chapter in Top Hat. Today I'm going to be drawing from your knowledge in this course and try to explore some of the things that we have up there. I'll try to give you a very practical perspective on what we're doing. And in the chapter in the book, I try to be a bit more systematic. I'm not going to be systematic today in my description, otherwise it will be very boring. But if you want to know more, you can read it in the book. I'll start with equity. And this is a recap. We already saw this. We already saw European options. These are options that mature, expire at the preset future time. We know when, in 3 months, in a year, 5 years. They have a payoff. And the payoff is an expression involving the price of the underlying at expiration. We saw the example of the call option with a strike price given by number K. It was that, and that is actually our 33-cent game was a call option. But now we can do call options with discrete time, with continuous time, and with a continuum of possible values for the asset value S. Same thing for put options, and we will see they are treated very similarly in the Black-Scholes formalism, and the results will be, well, there'll be some interesting things. But there, in the context of American options, we will see that the Black-Scholes theory also allows us to deal with the pricing of American options. And not only that, some of the features that came up earlier, like for example the points of indifference or the early exercise, they're going to come up in a very natural and very pleasing mathematical way. The type of mathematical objects they're going to give rise to are free boundary problems. They're very difficult problems in partial differential equations. I'll mention them, and as I said, today I'm going to be somewhat descriptive. I'm not going to be very detailed, more than usual. But that's the put options we have seen. Calls and puts, which are American, we have seen. You can exercise at any point in time. You don't have to wait for maturity to exercise your options. Another type of options which occur, and this is part of the practical mind I want you to have now. Okay, we have discussed American and European options and why they might occur. And now I want to introduce for you a new type of options. They are called Asian options. Some of you may be from Asia, and you may be wondering why are they called Asian options. The reason is this. I'll give you a true case. Imagine you're buying a call option from me. Oh, I have to give you a warning. I'm in a hotel, another week, and this hotel does not have excellent internet. And many of my calls throughout the day, they've been interrupted. If I get interrupted, just wait for me, I'll come back. Okay, I usually come back quickly. I don't get a blackout, I just get disconnected. So I'm saying this because I just got a warning, but it looks like I'm still with you. Okay, imagine we do a trade like this. We do, we're going to do a call option. You do it with me. This is a call option for a lot of money. It's significant for me. It's a big call option, a lot of money. And I am, let's say it's a call option on the price of oil. And let's say I'm a very big corporation, say Exxon. And there's a maturity date. On a particular date, we are going to exercise the option. I'm going to give you the payoff. But if I'm the one rating the option, and let's say I have the ability of changing the market just for a little bit, just for a few minutes at closing, then I have the ability to manipulate your option payoff. Do you understand what I'm saying? I can do a trade that is going to change the reference price of the option, and then I can make sure that your option expires worthless, for example, if you have an option with me. Now, it turns out that for markets which are illiquid, this could be the case. And they're called Asian because Asian markets, well, still today are not as liquid as, say, North American markets. And a few years ago, they were even less liquid. So let me now think of something which is more practical than the example I gave you. Let's say, you probably know, there are stocks that just never trade, or they trade once a year, or they trade once every few months. They don't trade every day. And in the Asian market, you can find those. You can find them in almost every market, but in some of these liquid markets, they happen. And if you don't know any, I'm sure you know of stocks that just trade very frequently. So imagine I give you an option on a stock that trades very infrequently. It trades once a year. Yes? Are you following me? Let's say we do a strike price of 75 cents and the stock is at $1. But it just never trades. Imagine that. It trades very infrequently. What I can do is, instead of giving you the 25 cents, what I can do is I can do a trade, just one trade, with myself, maybe, okay, where I trade the stock with myself for 75 cents that day, the day it matures. Then by doing that trade with myself, I ensure I don't give you the money. In other words, I can ensure that your option expires worthless. You see what I mean? This is an example of market manipulation. And I'm giving you a very simple example. And by the way, there's nothing illegal about this, in case you're thinking. So it's kind of tricky or risky to do derivatives with underlines which are not very liquid, isn't it? It doesn't matter how good your math is. I can do a trade that is going to render your option worthless. The stock would be at $5 and your strike price is 75 cents and you're getting ready for that big payoff day, and then I do a trade, maybe even with myself, so I don't lose money on the trade. And then I do that trade, that sets the price for the day, and then your option expires worthless. You see what I mean? Yeah, so this is how real markets work. Now, you don't have to go to extremes. The fact of the matter is that there are stocks that just don't trade very frequently. Energy is one of them. Some energy contracts just don't trade very frequently, and imagine some agricultural products too. So whenever you have an underlying that does not trade very frequently, then if you're going to do an option on that, you want some sort of protection against a move that just goes against you, and in 1 minute all your gains are gone. And Asian options were made for that reason. And the way Asian options are engineered is that they are dependent not on the one value of your underlying at one point in time. They will depend on the value of your underlying over a period, over time. Okay, so if I am going to be, say, manipulating that price, I'll have to manipulate it many times before it actually becomes significant. Okay, anyway, the option payoff is here. I included 3 versions of it. They're all calls. They could have been puts too, but they're like this, where you take the average payoff of different exercises, or you look at, this would be more natural, where you look at the reference price is the average of reference prices, okay? Or these are calls, and that would be a put. The next one will be a put, okay? I think there's a question in the chat. Yeah, the last one is a put, you're right, yes. Okay, the last one is a put. Good, you're paying attention. This is wonderful. Thank you. I thought the were all calls, but yeah, the last one is a put. But you understand why these things are done? Yeah. So these are Asian options. Some of them depends on the type. Like for example, this one we can still do in continuous time. This is going to be more difficult to do in continuous time. But anyway, we'll see that. We'll see that. Okay. There's other types of options. They're called Bermudan options. The reason they're called Bermudan is kind of funny. They're called Bermudan because they are halfway between European and American options. And someone figured that Bermuda is halfway between America and Europe, so Bermudan. That's where the name comes from. Okay. How do they work? Well, these are options that you are allowed to exercise whenever you want, but only at pre-specified dates. For example, Bermudan options are very typical. You can have an option, the stock moves, and you can exercise the option the last day of every month, for example. You pick the month, it's up to you, but only the last day. Why would someone do something like that? Who can think? Today I want you to be very practical. There's going to be a lot of math, but also I want you to be very practical in the way you think. Why would someone trade a Bermudan option? Let's say the last day of every month for a year. So this is how you think. An option typically is protection. You buy protection. Price protection. Someone is writing in the chat. I have difficulty monitoring the chat when I'm lecturing, but I do my best. You don't need flexibility as American. You can pay less. Exactly. So, Chris, you're right. You're exactly right. Pedro, yeah, you could be right too. Getting ready for that earnings report. Exactly. But the key sentence is what actually Daniel said the same thing too. Lower flexibility means lower price. That's good thinking, right? Sometimes I need price protection, but for example, let's say it's a Bermudan option on the currency exchange. Again, I am a company, Canadian company, I have my income in US dollars, my payroll is in Canadian dollars, and if that US dollar moves against me, okay, by going down, then it's, oh, that day I suffer, right? To make my payroll. So I buy this protection, but why would I want protection in the middle of the month? I have no payments due in the middle of the month. So as both Chris and Daniel say, I remove protection by saying, give it to me only at the end of the month, and therefore I may pay less. I pay less, why? Because I have less rights. Okay, that's where Bermudan options are exist. They typically are used by by counterparties who have the need for rebalancing, risk trades, things like that, that have to be done, say, at the end of a month, end of a quarter, things like that, and then that's how you buy your protection. Okay, good. So I'm glad that I got two answers right in the chat. I assume that most of you already knew that, which is great. You're developing that way of thinking, which is what I want. Okay, so this is the type of options that we see in the equity world. In the case of fixed income, what do we see? We see is bonds and bond options. Bonds we already examined. They were in assignment number 1. And they have bond options. You can have calls and puts, and bond calls and puts, they are exactly what they seem to be, which is you have the right to buy a bond cheaper. Now, they are a little bit tricky to price from a mathematical, from a trading perspective. They are very natural. You have to buy a bond, and they say, well, maybe I want to buy an option in case the bond price is too cheap or too expensive. You buy it as price protection. As we will see, this is not the type of trades you normally do in fixed income. You could do it. You would normally do other things. But if you do, then how do you price them? You can say, well, I'll price them the same way I price an option on a stock. And the answer is no, you can't do that, because bonds, you don't know the price tomorrow, you don't know the price in a week, but you know the price at maturity. They will mature at face value at 1 or 100, right? So it's an interesting derivative to price, because you know the future value, unlike a stock where the longer time goes by, the more uncertainty you have. With the bond is the opposite. The closer to maturity, the less the uncertainty you have. So I'm not going to address that, because options on bonds are really not what you normally trade. In the interest rate market, the options that people trade are a little bit different, and I have a list of them here. The first one is a cap. A cap is a contract that offers protection against time-dependent interest rates rising over a certain ceiling. In other words, if the interest rate rises above a certain ceiling, then you get paid a certain difference applied to a certain notional. Let's say you buy a cup from me at 5%. For whatever the reason, you're afraid of inflation, something. So if rates go above 5%, we pick a notional, say $1 million. And if rates go to 6%, then I'll pay you 1% on the $1 million notional. That will be the equivalent of a call option. A cap will be like a call. Okay, we specify the notional, and we specify that the strike price, which is the cap, it's called a cap rate, and then everything above it is something that you get paid. So it offers protection against rising interest rates. A floor is the opposite. It gives you protection against lowering interest rates. Okay? Who would want to buy a cap? Let's be practical. Who would want to buy a cap? Who can tell me the type of investor who would want to buy a cap? I'm going to assume that the bank is the one selling. The bank will sell you anything because, as we know, they can replicate it, and then whatever their cost is, they add a fee, and that's how they make money. By the way, today is probably the last day that I will be assuming that everybody works for free. Okay? Starting after reading week, we will start to assume that everybody makes money when they trade. Okay. So who would want to buy a cap? Say you're a pension plan, university pension plan, $20 billion in assets or something like that. If interest rates go high, is that good or bad for you? Let's say you're an insurance company. If interest rates go up or down, is that good or bad for you? Anybody here is an actuary? Anybody is an actuary here? If you're an actuary, please step forward. I want to talk a little bit, just a little bit, about actuarial science. Any actuaries in the room? I cannot believe it. I'm sure there's someone. Don't hide if you're an actuary. I love actuaries. No one?
I'm an actuary.
Okay, Theo, right?
Yeah.
Okay, Theo, you're an actuary. So let's say you're a pension or you're an insurance company. If rates go up, is that good or bad for you?
If rates go up, then you think of it as, sorry, did you say insurance or pension?
Pension, doesn't matter. They have exactly the same problem.
I guess if rates are higher, then the present value of your payments that you have to pay out for claims will be lower.
Exactly. Very well done. Exactly. That's what actuarial science is really all about. Okay, I mean, I'm oversimplifying this, but this is what actuaries do, Theo, and you did it exactly right. Okay, so by interest, you mean the bond interest rate? Yes, Chris, the interest rate, the going interest rate. I'm not going to be very particular as to how I express myself, right? So Theo, let's continue to talk, you and I, okay? I want everybody to understand something very important here, very important. When you are a pension or an insurance company, you have money to manage. That money is there for what reason? Well, people like you, by you I mean everybody here, Chris, Pedro, I mean many of you contribute to CPP, to your Canada pension plan, right? So you give them money now because you expect them to give you money later. So from a pension perspective, the money you have is money which you will have to give to other people later. And the future value of that money is a function of interest rates. If rates are high, the future value of that money is lower. If rates are low, the future value of that money is higher. That's what Theo is saying. The money you have to pay is called a liability. These are liabilities, they're not due now. No, they are due when you retire. That's in 40 years for many of you, right? These future liabilities have a present value today, which is linked to interest rates. If rates are high, the liabilities are low. You see? The present value of liabilities is low. Everybody sees that? This is like the thing we saw the first day here in this course. It's all clear? Well, I hope it's clear. This is important. I'm assuming everybody sees this clearly, right? Tell us. And this is what actuaries do. In fact, I'll tell you more. And this is now maybe beyond this class, but into your professional career. Most of you are going to be working on the asset side of the business, which is you have assets and you need to manage the assets. And a few of you, not many, but a few of you will be working on the liability side of the business. They are different. And actuaries typically work on the liability side of the business. You manage what you owe, not what you have. Okay, so Theo, I don't know what your job will be. I hope you're very successful, whatever it is that you do in your career. Okay, but what most actuaries do is they worry about the liability side of the equation. And when you go to a pension or an insurance company, you have two sides to that business. You have the asset side and the liability side. And the liability, they worry about what they have to pay. Oh my God, I have all these insurance claims. If there's a hurricane, I have to pay a lot of money out there. They worry about the liability. And the people with the assets worry about the assets. I have all these hundreds of millions of dollars that I have to invest. I'm going to buy bond forwards. We already saw that, right? So you have to make that money produce yield. There's two sides to that. And what many of these firms do, they do what's called asset liability management. You manage both simultaneously. And this is a very big deal because we'll see a lot of this coming up later, but today is the first time it shows up, which is for some people making 5% looks like great. But other people say, well, my liabilities are 7, making 5 is going to put me into a negative actuarial position. So it's as if I'm underfunded. I don't have money, right? Okay, so there are situations like pensions and insurance companies are examples where if rates go up, that's good for them, but if they go down, that's bad for them. So what would they buy? What would a pension or insurance company buy? If they have to buy something which is, say, a cap or a floor, well, just a cap or a floor, what would they do? What would they buy? You buy a floor. Because if rates go down, the value of the liabilities goes up, but then the value of the assets goes up too. Right? So buying a floor is a typical example of an asset liability management trade. It's a liability driven trade. You match your assets to your liabilities. You understand what I'm saying? I hope you do. But let's say now you have a mortgage. You're a person with a mortgage, a floating rate mortgage. Many people are going through trouble these days. You may have read the news, right? What's happened to people that are on a variable mortgage these days? Have you read this in the news? Have you? You should read the news, by the way. Didn't I tell you that? You should read the news. Pedro has a question. When banks offer fixed mortgages rates, do they invest in MBS or bond options to offset? Okay, that's a very good question, Pedro. Let me tell you what banks do is they sell their mortgage and then they sell the mortgage to other people, typically hedge funds. So they manage all of that. Yes, and in a certain sense, this is what I'm going to be talking about. And this is where I'm going with this, right? If I have a mortgage, what do I have? I have something that when rates go up, it hurts. I have to pay more. And Kelvin said the payment spiked. Yes, people on variable mortgages, they are freaking out because rates are much higher now than they were, say, a year ago or 2 years ago, certainly. So if you have a I mean, this is a bit of a weird trade, but there's a point where I'm asking this question. You can all imagine being a mortgage holder, right? You probably know someone. If you don't have a mortgage, you probably know someone who has a mortgage. Yes? Well, you know me, I have a mortgage. And so people with mortgages now are somehow hurting. So what would happen if you had bought a cap You buy it, it has a premium, you pay for it. What happens if you buy a cap and rates go up? Well, if rates go up, the cap will pay you. So a cap is protection against rates rising, right? So wouldn't you think that therefore a fixed rate mortgage is a floating rate mortgage with a cap? Does it make sense to you? Right? So a fixed rate mortgage, which everybody knows, you go to any bank and that's what they have. Actually, it probably is a floating rate mortgage with a cap. And if there is a market for caps, a cap is a call option. We know how to hedge it. We know how to trade it, right? Then engineering a fixed rate mortgage should not be very difficult. You just get the floating rate mortgage, which is you just buy money of the money market, and then you implement an option strategy, as we will see today, where the underlying is interest rates, not a stock. Does it ring a bell? And actually, you know what? If you look around, many of the financial products that banks will sell you are derivatives in one way or another, right? The fixed rate mortgage is an example. And when I say that the bank sells the mortgage to a hedge fund, what does the hedge fund do? They replicate the option, they buy options off the market, whatever it is that makes them money. But this is essentially a derivative. A mortgage is a derivative. It's a call option on interest rates. It's a cap. So if we know how to price call options in real time, not only we can price, a call option on Apple stock, which by the way is not very interesting. You can actually engineer a fixed rate mortgage, which sounds much more attractive, doesn't it? Or no, maybe not. How many people do you know with a mortgage, with a fixed rate mortgage? Don't answer, just think. How many people do you know with a fixed rate mortgage? Maybe your parents, maybe your uncle, your aunt, maybe your grandparents. I have no idea. You know people. How many people do you know who own options on Apple stock? Probably none. Okay. So a lot of these options theories that we're seeing here, they're actually applied more on the fixed income market than in the stock market. Although I will say stock when I refer to the underlying, maybe I say underlying in general. I want you to know that a lot of the products that exist out there, derivative prices exist out there, are actually of fixed income instruments more than stocks. Just a note, okay? Just a mental note that what we're seeing today is going to be of interest also there. And of course, it's interesting in the futures markets, for energy and lots of other things. I want you to be very open-minded as to where we can apply all of these theories. It is true, Scholes and Black, they worked on option prices. They actually developed the Black-Scholes theory on stocks, especially from a employee compensation package perspective, but they are used for lots of other uses, in particular fixed income derivative. Is this clear? And if you happen to end up Tao on the liability side of the industry, well, there's going to be no shortage of opportunities for you to see derivatives also playing a role in managing assets and liabilities within a firm. Okay, just be aware of that. Now, here's the next question. A cap, when you buy a cap, you pay money. But if you are going to sell protection with a floor, you are long cap, short floor, then you're going to get money. A collar is a combination of a cap and a floor, usually long the cap, short the floor, or vice versa. And the thing is that if you set the ceiling and the floor carefully, the collars can be free. One will pay for the other. They are called zero collars. You understand? There's a similar trade with stocks, which is you you sell a put and you buy a call. When you sell a put, sorry, the other way around. You sell a call, you buy a put. Okay. If you sell a call and you buy a put, you're basically guaranteeing that the stock is going to be within a certain band. When the stock goes below the band, then you get some money, and when it goes above the call, you pay some money, and that means that you're essentially guaranteed. It's a way to guarantee that the stock is within that band. When you do a zero collar, you're basically doing the same thing with interest rates. It guarantees that your interest rates will move around that band. You will be compensated if it goes above or below. Okay, that's a zero collar. It's a way to get some interest rate certainty for the future by having a long cap, short floor. I guess you understand what I'm saying. Now, a swap is something that I think we already described earlier. We're going to see a swap in great detail on February 27. Great detail. There's a swap that happened in 1983, I think, or 82. I forget the year now. We're going to see in great detail. And a swap is an exchange of payments. I just say I will pay you the going interest rate, and then you pay me a fixed rate, say 2%. So when rates go up, I pay you, and when rates go down, you pay me. We just exchange payments like that. It's a way to switch from fixed to floating. You could think as a variable rate mortgage as something which is free because you just buy money off the money market, and you can think of a fixed rate mortgage as well as what it is a derivative, but you can think of them as actually a swap of some sort where we exchange payments. Of course, exchanging payments has risk, which you'll have to hedge. We're back to the concept of the derivative value, the optionality in a mortgage, and how you hedge it. But a swap has that. It could be viewed as a derivative also. Now, swap markets became very, very big in the 80s. That was after the US-Iran oil embargo. And this created a lot of disruption to financial markets, including interest rates. And the way people found protection from these very volatile interest rates was through the issuance and buying of swaps. And we will see an example of that. Swaptions are options on swaps. So from a certain sense, you could think of a swaption as a derivative of a derivative. Now, the swap is a particularly simple derivative. In fact, it's fairly easy to replicate a swap with bond portfolios, as we did with forwards earlier in this course. So a swaption is just an option on that. When swaps became very liquid, to do swaptions was a very good way to obtain protection by doing something that was remarkably cheap. Okay, and then you have cross-currency swaps and lots of other things. Now, I want to leave it here. I hope this was a good summary of how the option market operates and who needs it and what you do about that. Yes, I hope so. We know how to price these things in discrete time. What I'm going to do now is I'm going to talk about how to price these things in continuous times. Now I'm going to do that, and that's what I'm going to do. And now comes the refresher. This is what we discussed last week. We're going to think of time with infinitesimal time intervals, dt. Think of these over like a day in a year, for example. So dt will be like 1 over 365. That is if you're looking at a daily trades in a year. You can think of let's see, even continuous time. You can think of dt as to be equal to, say, 1 second. Okay, or maybe even 1 tick. 1 tick is even faster. You know what a tick is? It's every time a stock changes hands, that's a tick. And you can have many ticks per second. Okay, doesn't matter to us. We call it dt. Could be anything. Could be anything. And then we learned that Brownian motion is a type of motion that moves up and down with a probability of 50% by an amount equal to the square root of dt. That was the whole point of class last week, to learn that dt has an expression in price which has to be the square root of that. Because of cancellations, we need the infinitesimal price moves to be infinitely large compared to the time increments. Infinitely large precisely at this rate, at the rate of the square root of the time increment. We saw this last week. This is, I think, was very well understood. I spent so much time on this. The expectation of an infinitesimal change in Brownian motion is 0, and the size is about the square root of this, is about this, the square root of the time increment, dt. After a t unit of time, they are described by a random variable, which is Gaussian, with variance equals to t. The standard deviation is square root of t. That's what it is. This is Brownian motion. And I'm describing Brownian motion not in mathematical, not in rigorous terms. I'm describing Brownian motion in intuitive terms. I don't have time nor the interest to get into the formalism of this. If any one of you ever wants to do a PhD thesis in this area, then you will have to learn the formalism. But in this course, I'm not going to do it. And then we saw Ito processes, and in particular, we argued that the type of stock process we want to consider is something like this. We saw this guarantees that stock prices are not negative, which is something which is in accordance to law, which is good. We like it. We saw the meaning of the trend mu and the volatility sigma. Okay, and it seems that this is a very plausible model to work with. We developed that last week. We're going to go ahead with that. So the next question I have is, if stocks move like this, how can we price options? In order to do that, we saw Ito's lemma was a critical, it's a critical element for our argument, and it was the equivalent of Taylor's expansion in a stochastic world. And Ito's lemma contains the normal part, the thing that we are used to from the calculus we know, and the part which is new, which is related to the stochastic nature of what we're dealing with. This is the stochastic signature. As we saw, volatility creates trends, exactly like that. And then we saw a particular case, a particular application of that is that if we look at how the logarithm of the stock price moves, it moves in similar fashion to the stock itself, but the drift is lower, exactly 1/2 of the volatility squared lower. Which, by the way, it's going to come up when we study investments later in the relationship that we have between returns and log returns. That's a return and that's a log return. We will see that from a Ito perspective. They're both different by exactly this. But this will come up later when we study investments. Right now, it's just a mathematical formula. All right, so with all of this, we can now do the Black-Scholes theory fairly simply, fairly quickly. Okay, I'm going to do it, and then I'll pause and see how you're doing with that. We are going to consider stock. The stock moves infinitesimally according to its Ito process. And we have an option, let's say call option, put option, or something else. We don't care. In fact, it doesn't even have to be an option as long as it has a payoff. So this is a payoff function. What we're going to do is, for a payoff function, we're going to calculate the value of the option with that payoff at maturity. We're going to do the European case only. Then I'll tell you how we can approach the American case. Okay? All right. So the way I'm going to do this, as you can imagine, is by building the replicating portfolio. Building replicating portfolios is something that we now know very well. And the first day when I explained to you the 33-cent gain, I was able to trade with someone, I think it was Zach, who was willing to pay 50 cents. And then I built a portfolio that always made me money. And we converged by thinking together, all of us in the room, into what the replicating portfolio would be. So we come up with a replicating portfolio somehow by trial and error. Today, I want to show you what a replicating portfolio is with hindsight, knowing what I'm looking for. So it's going to look a bit like magic, I know. So allow me to do a bit of magic. I'm using hindsight, but then I'll tell you why this is the choice we should have made, just like when we introduced the 33-cent gain. So this is my replicating portfolio. My replicating portfolio is going to consist of the option itself. So this is not bonds and stocks. It's the option and a certain number of stocks equal to this number. Kind of weird. Let me explain this. We're not going to get into why this. This is the choice. This is how many stocks I'm going to buy. I'm not going to get into why exactly this until a little bit later. Okay, I'm not going to get into that. What I want you to pay attention is that here I'm doing something which is rather bold, which is I don't know my price function. And I'm building my portfolio based on the derivative of the price function, which I don't know. That's what mathematicians do. We do this all the time. We don't know something, we give it a name, and then move on. Take derivatives, take integral, whatever you have to do with that. Of course, here we should make sure that when I say this is the portfolio I built, that this function actually has a derivative. That's the only assumption I'm making. Let me not get into why I know it has a derivative, but if it has a derivative, why not? I build this portfolio and let's see if it replicates anything. This is the faith I need you to have in me right now. This is the magic I'm doing for you. Are you okay with that? Again, this is the payoff of the function, but it's now, so it's not the payoff at maturity. That I know what it is. And in fact, some of you may say, wait a minute, at maturity, that's my payoff function. That's my option, call option payoff function. It has no derivative there. Yes, I know. I told you, I'm making an assumption that at maturity, it may not have a derivative, but I'm making the assumption that today it does. It's okay. Bear with me. Okay? Again, I need you to trust me for a little bit. I need to assume that this function exists, that's number one, and that it has a derivative, which is another assumption. So with these assumptions, I can build this portfolio. This is the number of stocks I have. And note that I'm going short the stocks if that derivative is positive. And I'll be going long if that derivative is negative. I'm not going to get into that right now. Okay, but just note. All right. Now, if my portfolio is the option and the stock, and the option is priced as F, and my stock is a S, then that's my portfolio, which I call pi. Then, as you can see here, my portfolio will move like this. Now, this is the first thing that I need to explain. I need to go very slowly through this. The portfolio will change by the change in F, which I have here, and the change in S that I have here. Is everybody convinced this is the case? It's all good? Everybody is with me? Everybody is with me? Then I have a question before I continue. I have a question. I would say there's something missing here. What about this? What about this? Because A is stochastic too. A also changes through time. So how about this? That term seems to be missing. Sorry, maybe I'll call it like that, it's more clear. That term seems to be missing. No? Why is this term not here? Let me tell you. So this term is not here. In fact, we're going to assume this term is 0. This is what's called the self-financing condition. What does this mean? That means that A will change, but A will change in such a way that I do not spend any money rebalancing this portfolio. This portfolio, as stocks go up and down, will also change in value. I spend no money doing that. I get all of the money to buy the stock from the stock itself. Okay, that's what this condition means, and it's called the self-financing condition. This is critical. This is where finance enters into our argument. Okay, I'll come back to this. Okay, so that's...
So what does that mean mathematically? So the derivative of A with respect to T is 0? Is that what the self-financing condition says?
That's right. This is the self-financing condition.
Yeah, but why do you have to write it in product form? Because if that thing is 0, then you have to necessarily imply the AT should be 0. Is that, or am I not understanding correctly?
Well, no. That means that DAT, this number does not change. Okay.
Right. So you mean, sorry, the derivative doesn't change. You mean DAT doesn't change? Is that? But I thought the equation is DAT times S, right? And that is 0. So I thought if you eliminate S, then it necessarily implies AT should be constant.
Okay, so let me come back to this a little. Let me finish this, and then I'll come back to this. Okay.
Okay.
All right. So that's how my equation changes, and then what I do is I apply Ito's lemma to my. I plug in A for what it is. Okay, and then I apply Ito's lemma to the option price F. When I apply Ito's lemma to the option price F, what I have is that's for Ito's lemma. That is here, and this is Ito's lemma. And now, with hindsight, I mean, this is the hindsight that I used earlier, I can see that this and that cancels each other, right? Because I bring in the value of A for what it is. And in doing that, if these terms cancel each other, this is what I have left. Now, before I continue, note one thing. A miracle just happened. And this is it's not exactly a miracle because it's forced by my choice of A. Right? Is forced by my choice of A. My choice of A forces that these things kill each other. That's why I chose this. Now, what's the big deal of killing these two terms? Well, the big deal is that what I have here has no DW. So, in other words, this is deterministic. It's not stochastic. Okay? It's not stochastic. So if it's not stochastic, what is it? I have a portfolio and I know the price in the future at all times with certainty. Then what is it? It's a bond, it's a savings account. So I know that this is equal to the going rate times the value of the portfolio. Okay? Are you following me? So if this equals R times the portfolio, which is the option plus AS, then I have an equation here. Chris, I'm coming to, you're saying this is the replicating portfolio. Let me say, this is the replicating portfolio of a bond. Okay, it's not the replicating portfolio of the option, it's the replicating portfolio of a bond. That's where I'm going. So I did this a little bit backwards. When I created my option by 33-cent game, I replicated the option. But now I'm taking the option and stock and I replicate a bond. But of course, it's the same thing. It's just easier this way because it's easier to see the bond than to see the option. So everybody's with me that this is a bond. If this portfolio is a bond, I say this portfolio is the option minus AS stocks. If that's a bond, well, guess what? This is consistent with what is a bond, not a bond of a notional one, it's a bond. This is consistent with what we knew earlier, that the option is a bond and some stocks. Okay? In this case, it would be maybe a negative number of bonds. I'm borrowing. Okay? We don't know the sign. The sign is going to be dictated by the sign of A. But anyway, we'll go there. Okay? So it's the same argument that we used the first day when I was doing this with Zach, I seem to remember. Except there, he was paying me the option. I was borrowing money from my bank, and I forgot your name. Dear bank, I forgot your name. Are you in the audience? Remember your name. Shirley, maybe? I don't know. Forgot the name of my bank. And then I used that to buy the stock. Now, what I'm doing is I'm doing the option, short the stock, and then that becomes a bond. It's the same thing. It's the same thing financially. Mathematically, very different, but it's the same thing financially. You see? Now, the fact that this becomes, Yuja, I didn't forget your question, okay? I'm coming back, okay? The fact that I have that, then this is the equation I have. When I write my bond or my portfolio that growing at the rate, at the interest rate, at the risk-free interest rate, that becomes this equation that I have here. And because I know that at maturity, the value of the option is equal to the payoff, then I have that. So this is the equation that I have. And this is called the Black-Scholes equation. Okay? Okay, I will make some comments about this equation now, but we arrived at an equation. It's an equation which is, you just look at it, it's a partial derivatives equation. Partial derivatives. Okay? All right. Now, we have arrived. This is the Black-Scholes equation. I'm going to tell you a lot of things about this, but we have arrived. I'm going to go back to the previous question that I said earlier. I said this, dAT times S is equal to 0. And Yuja, you said that, well, this then must imply that dA is equal to 0. Right? You're right. That's what that implies.
Yes.
That's what that implies. Okay? Self-financing condition. That means that the number of infinitesimal changes in A is 0. But of course, A at some point has to change. And the way to understand this is if you go back to the tree method that we saw, you will see that from one node to the rest, so one node to the next, the number of stocks would change, but it would change in a self-financing way, which is that the change will affect the value of the portfolio. But this is something that we don't trade. So between now and the next move, we don't trade. Okay, but then A will change itself after that. Now, this is something which, since I'm using a shortcut, since I'm using an intuitive way of thinking about Brownian motion as steps when it's actually not steps, I just want you to be aware that what I'm doing here is the equivalent we did in the tree process okay, which is I buy and sell, but then this is not to imply, this does not imply that over time A is constant. It does not imply that A is constant. It just implies that in this infinitesimal change, when I do a trade, the number of I don't change the number of stocks at that point. The number of stocks will change in the next step because of this, and that it will affect the value of the portfolio. Okay, so in the end, this means that I don't put money into the portfolio will change its value because of S and B being going up and down, not because I take money in and out of the portfolio. And that's what this condition means. Okay, I don't know if that's clear. So yes, you were right. A does not change, but that doesn't mean that A will always be the same. I am not changing A. A will change because S and B will change in values, but it's not because I change it. I don't take money in and out of the portfolio. That's the way to understand that. Okay. This part is a little bit tricky. If it's not clear, then this is what I need you to do. Go back to any of the examples we have where 3 examples. The examples that we have, and then see that if I don't change A, meaning that the stocks that I buy, A will change because S changes, not because I change it. So there was an interesting question comment in the chat. Because it's A.ds, you're not buying more. Exactly, that's what I'm saying. I'm not buying more stock. Okay? So the value of A will change, but not because I buy. So that's why, again, this is one of the problems with this simplified formalism I'm introducing to you, where I say Brownian motion is like a coin flip. Turns out that if it's a coin flip takes time. And what I'm saying is that in that time that I flip the coin, I don't buy and sell more stocks at that time. Okay, I'll say I'll buy and sell more stocks at the next time. And this is where it gets tricky, because if I say time is 0, well, what does it mean before or after 0 time? You see what I mean? Someone is saying, there was a question in the chat. No, so what is that? How? I don't understand your question. I don't understand your question. Do not contain T variable. So DSFST, I don't understand that. So this is what how is asking. A is not, no, A depends on T. Yes, it does depend on T. Yes, A depends on T. He's asking if A is a function. Yes, A is a function of time. Yes, it's a function of time. Yeah, it's a function of S and time. But what I'm saying is that as a stock moves, I don't buy and sell stock. When it stops moving, then I buy and sell stock. And then you say, how is that possible? Time is 0. Well, time is not exactly 0. I'm simplifying. I'm trying to use stochastic calculus in the context of the 3 pricing methods that we saw earlier. Okay, so although time is 0, they say before and after 0. Okay, this method is good to understand Black-Scholes, but it does have this type of, I guess, assumptions that you have to make. Yeah? Okay, Chris is saying the portfolio is constructed at a given time using a particular value of which equal. And a portfolio constructed this way would replicate a bond. Yes, exactly. At a different time, you would need a different A to exactly. That's what I'm saying. But of course, when it's all continuous time, what does that mean? That's all I'm trying to say. I don't want to be formal about this. I just want you to have the intuition. Basically, see, this is the key. Once we know that the price change is the square root of the time change, once we know that, then we can recover our tree pricing process, use that, and then replicate it. And then it's going to work in the limit as dt goes to 0. So I'm appealing to your intuition of a tree pricing process using the notation that we know is going to work when we go to the limit dt goes to 0. That's what I'm trying to do. That's where I can talk about before and after a trade. That's where I can talk before and after a stock moves. It's real time, but I can still talk about before and after stock moves. It's one of the licenses that I can have because of this model that I've developed. You're going to write a PhD thesis about this, then you have to do it differently. With lots of, you will actually not use Ito processes like this. You write integrals, stochastic integrals, and this and that. I don't want to do that. I prefer that you understand it from this perspective, okay? From a trading perspective, because then the trading aspects of this are very clear. I didn't say this to confuse you. I just said this so that you see how powerful it is what we developed last week. That it allows us to say things such as before and after time 0. Because what we're doing is we're just using the same approach we did with trees in continuous time. That's all I'm saying. Okay? Okay, let me continue. Once I finish this, I'll take a short break. Okay, let me continue and then tell you about the marvels of this. This is the Black-Scholes equation. Now, some of you, most of you, probably actually all of you, have taken a course in differential equations. So this probably sounds familiar to you, right? Remember there was the heat equation. It was written like this. I did it here in class. Well, sorry, I don't like my notation. That was the heat equation. Yes? Okay, what are the similarities between this equation and that equation? They look very similar. That's the derivative with respect to time. That's what we have here. Yeah, okay, so those are related. That is related. As you know, when you took differential equations, lower order terms don't really change the character of the equation we're looking at. So this equation we have here, morally is that and that. We can somehow, I'm going to write here, I'm going to use the multi-eraser, but I'm going to do a visual trick, okay? I'm going to do a visual trick. Morally, that's the equation we have. Forget that. I'm trying to erase that. Okay? It doesn't erase very well on the screen. But that's what I'm trying to do. I'm trying to erase that. Morally, when you look at differential equations, the lower order terms don't matter. Note how a weird mathematician I am being today. Okay? I'm appealing to your intuition every time I do something. It's because I want to do all of this in one day and then move on. So you have to stay with me, okay? When you look at differential equations, you would have learned that lower order terms don't really matter, usually, okay? Therefore, what matters is this. And that is like the heat equation, right? With one key difference. What's the key difference? There are two differences. One is key, one is less key. What's the key difference? Who can say? What's the key difference? And Pedro, you say, can a Rastis dissolve using the Laplace transform? Yes, you're right. That's how you do it. I come to that later. I'm less interested in that right now. I'm less interested in how you solve this. I'm interested in how this equation behaves. Quadratic dependent on s. Okay, so this is, we're saying this. So Chris is saying that a difference is that is not here. And you're right. If I write an x squared there, that would be the same. This is a difference, is not a key difference. It's not a key difference. It is a difference. Okay, I agree with you, it's a difference, but that's not a key difference. What's the key difference?
Sign.
The sign. That's the key difference. What if I gave you this equation? What if I gave you this heat equation? Now, this is for the reason that differential equations is a prerequisite for this course is precisely for this reason. Okay, what if I told you this is the heat equation and just ask you to solve it? Who can solve this heat equation? And Petro, you don't need to be rusty. This will not work. The Laplace transform will not work here. But you can think, what is the effect of this minus sign? What's the effect of the minus sign? That minus sign is time reversal, right? That minus sign is as if time sign is here. And if sign is here because this is the derivative with respect to time, it's as if I'm going backwards in time. You see? By the chain rule. Changing the sign of my first derivative is like going backwards in time. So Chris is saying concentrates heat rather than averages heat. No. No. It moves backwards in time. It makes sine a possible solution. I thought it makes sin a possible solution. No. Also no. Kelvin, no. This is going backwards in time. This equation will correspond to the following physical problem. I give you the heat distribution in a certain one-dimensional rod. And I ask you, what was the distribution yesterday? That's what this equation is doing. We don't have answers for that. I can tell you what the distribution will be tomorrow, but I cannot tell you where it was yesterday. I don't know that. No one knows that. There are infinitely many possible solutions which are consistent with the temperature now. You see? You see? There's a very interesting, Chris, you're saying something very interesting. You probably have seen a video that has something blurred, right? Can you unblur a video? No, you can't. No, not always. No, never. If your blur is with Gaussian blur, you cannot do that. That's what this means. That would be like I'm blurring a video. You cannot do that. If you have some restrictions as to, then maybe, because it's a problem with infinitely many solutions. If you have a way of saying, these infinitely many solutions, I only want this one because I know that the total mass is equal to something. Well, that's different. That's different. Sorry. If you have a way of eliminating those solutions, that yes, but usually you can't. You cannot go back in time to find what the temperature was yesterday. You cannot unblur a video. These are diffusion processes. Diffusion processes are not reversible. They're not. However, you probably know this. If this is the wave equation, then the answer is yes. Light can move forward and backward. If I know what the light is now, I know what it was before. These are reversible, but diffusion processes are not reversible. So then that looks like a problem, no? If I cannot know what the temperature distribution was yesterday, how can I know the solution to this equation? Who can tell me? Actually, Theo, you are right, because this change of sign comes with another reversal in the condition here, because this is not an initial value problem, this is a terminal value problem. So it's actually the right equation. If we didn't have that minus sign there, there will be no solution to this, because this is an equation that travels backwards. See, we solved our option prices on a tree going backwards, right? That's no coincidence, because from a PDE perspective, we're also solving it backwards. This is what's called a backward diffusion equation. This is a backward diffusion. This is a terminal condition, not an initial condition, and of course that minus sign is needed, otherwise there is no solution. You see, it all agrees. This is wonderful. It works. Theo is right. We can change t to minus t, then the minus disappears, and my terminal value problem becomes an initial value problem, just like the heat equation. But of course, we're not going to do that. Who would want to do that? We would like to take time to minus time. We just solve it backwards, like we did with the trees. You see? This is amazing. I have to say one thing. There's a corollary to this, which is this thing that you just saw here is not different from the 33-cent game. It's exactly the same. There's no new information here. Nothing is new, isn't it? The same thing that I did with Zach, I don't know how many weeks ago, is still the same thing we're doing here. Continuous time and all, but it's the same thing. I hope you're with me. I told you today I was going to be very descriptive. I don't care about the details. I want you to understand all of this from a descriptive perspective. Yes? Okay, I need this to sink in. We have climbed a very tall hill only to realize that in a certain sense we've been here before. Don't you have a sense of deja vu? All of this is like not new. Lots of walking, lots of going up and down, but it looks like we ended at the same place as several weeks ago. I'll tell you more, just in case the sense of deja vu is not big enough in you. Let me ask you a question. When you look at the Black-Scholes equation, where is mu? Mu is the drift in my stock price, right? Where is mu? Who can see mu there? Is it hidden somewhere? Where is mu? Nowhere. Why? What happened to mu? What happened to mu? How come it's nowhere? This is the risk neutral measure. Exactly. It happened to us too. Don't you remember? When we priced the option at 33 cents, the 50% probability was we didn't use it, wasn't anywhere. Right? So the probability didn't show up. And of course here it doesn't show up. That's where mu is. Mu is in the real world measure. We don't care for it. We want the risk neutral measure. In a certain sense, that's mu. It's been replaced by R. So even this is the same thing that we saw weeks ago. Even this is what we saw weeks ago. Do you see that? The risk neutral measure comes up naturally. It's simple. The interest rates just come in and replace mu, and we are done. And if you don't believe me, I know if you don't believe me, it's not because you don't believe me. I know it's just don't understand me. If you don't understand me, let me show you the solution to this equation, and then it'll probably become even more clear. This equation has a solution. It's written here. I am not going to do the Laplace transform and all of that. I'm not going to do that. I told you today, no details. I just want you to understand this from a descriptive perspective. So you're going to trust me. This is the answer. Okay. By the way, this is an answer that we've already seen before. Why? Because in this expression, what is that? Well, that's the payoff. And what is this inside? Well, what I have inside is, that is the future value of my stock, right? Look at how the logarithm changed. The logarithm had exactly that drift. So that means that the logarithm of the stock is going to have that distribution with that probability distribution. So that is the future value of, that's the future value of S. Expectation. So this is the expected payoff. Everything here is the expected payoff. You see? You see that? And what is that? That's the present value, the discount value. So remember how the very first day when we look at the 33-cent gain, we immediately introduced the risk neutral measure and we said this is the expected discounted payoff according to the risk neutral measure. That's what we said. Well, here's the same thing here. That's the discounted expected payoff according to the risk neutral measure. The risk neutral measure is replacing mu by R. You see? Even this is not new. Even this is exactly the same thing we did weeks ago. The sense of deja vu should be like massive now. True, you need to know a little bit of math so that the deja vu sinks in, right? This means that my future values of the stock are governed not by mu, but by R. That's what the risk neutral measure was. The stock is expected to move with interest rates. In other words, it's a martingale. Too many coincidences, don't you think? Between the Black-Scholes theory and our 33-cent gain. Don't you think? You see that? Okay. Mission accomplished. We have the Black-Scholes theory. We have seen that in a certain sense it's the same thing we saw weeks ago. Of course, I'm not going to say that we haven't learned anything. We've learned so much. In fact, it's because we've learned so much that this looks like what we learned weeks ago. It's like when you learn Hilbert spaces perfectly, you realize that it all boils down to Pythagoras' theorem. It's not that you didn't learn anything. Of course, you know, for those of you who understand what I'm saying is, when you see Hilbert spaces, oh my goodness, Fourier series and the MP3 technology all boils down to Pythagoras' theorem. Once you understand that it's not that you didn't learn anything, is that suddenly everything becomes the same thing. You found the kernel, you found the origin of everything, and that's where we're at. And there's no more. There really is no more. You can price fixed rate mortgages with this because there are call options on interest rate that change every day. And how do you use it to price the options? You still need, yes, but this is given to me. This is S minus K plus. I already know that. I'm talking UGR. Don't you see? I already know that. Or if you want, you can go here. That's the F. You already have that. And then you do this integral, you put it into the computer and you get a number. Computers can calculate the numerical value of this integral. So that's how you use it to calculate the value. Yuja? Is that clear?
Yeah, but I was thinking you need capital T, right?
Capital T is the expiration time. I know that. It's in a year, so that's T is 1.
Oh.
Right? If we're talking about European options, I hope you're not talking about American options. I hope you're not all that way ahead of us.
That's what I had in my American option.
No. Wait,
yeah,
you're going too fast. No, you went to a different mountain. Please come back. Okay, we're still with European options. We're still with European options. I didn't go to American options. That's a different mountain.
Okay.
It's a different mountain. By the way, when we go to that mountain, you're going to say, "Oh, it's still the same mountains." Yes, I know. I mean, look, of course, right? Mm-hmm.
Okay.
Yeah.
So it's clear with the.
It's clear,
European
right?
base.
Good. Is it clear to everybody? Is it clear to everybody? Okay. We're going to take a 15-minute break. Okay? You go get your tea, do whatever it is that you do, but try to not forget this. Try not to forget this. When we come back, I will make a few more remarks about this. I'll talk about American options and this and that. I'm going to be super descriptive there, super descriptive. Okay? Again, I really don't care about a lot of these details. And then what I will do is I will show you a package of pricing options, a numerical package, and I will end my class that way, okay, with something super practical, okay? So we're going to take a 15-minute break, and please, in these 15 minutes, no, don't completely leave. Think of questions you would like to ask, because I would like everybody to understand this. This is a momentous time in this course, okay? Black-Scholes theory, Nobel Prize 1997, this and that, big deal. Next week, next week is reading week. Week after that, we start assuming that you make money when you trade, and then everything changes. Everything will be completely different, right? But this is the foundations on which everything else is based. That's what we have discovered, okay? Maybe I want to see if there are any questions before I continue and I tell you a few more pieces of information. Do you have any questions, anybody? So I'm not going to say it's clear. I'm sure it's not clear, but I hope you have a sense of accomplishment. I think you could spend some time on this and then make everything clear. Okay, so let's look at this equation. This is the Black-Scholes equation, okay? It's, again, what does it say? So it says that's the option price when the value of the underlying is S and at time t, think of this as points in the tree, right? A certain time and a certain price. We've seen this before. The value of the option at that time is the discounted, that's the interest rates, that's the time to maturity. Time changes, t is the time at maturity, so that's the time to maturity. Of what? Of the expectation. That's an expectation because it's an integral against the Gaussian, which is here. The expectation of these future values. And these future values are given by the exponential of the stock price. The exponential of the the expression of the logarithm of the stock. The logarithm of the stock price follows an Ito process, therefore it has a Brownian distribution, and that's the one which is in the exponent. Okay, so we're solving this by solving for the logarithm of S as the Ito process, which is the one that has Brownian motion in it. So it's all consistent, it's all the things that we expected. And of course, R replaces mu. So that part is clear. Expected discounted payoff. The same as the 33 cents when you choose the right probability. And that's what we have here. That's the right probability. Okay? Because that's the Brownian motion that prices the bond and the stock. Okay. What would happen if I tried to use this approach to price American options? Well, note one thing. And now you need to look, if you don't understand what I'm going to say now, it's okay. Okay, just try to remember the feeling that you have when you hear me, because not everybody will understand this. But there is this thing called the maximum principle. You've heard of the maximum principle, right? You probably saw it in complex variables. You probably saw it in differential equations. What does it say? What does the maximum principle say? In the context of diffusion equations, what it says is that if you have a one-dimensional rod with a certain heat distribution, some places are cold, some are warm, which is that as time goes by, the hottest and the coldest spots were always in the past. Actually, they were on the boundary. The boundary is, say, time equals 0. That's what it is. Okay? That's what it is. That's what the maximum principle says in this context. You can have, if this is the hottest place, this is not going to get any hotter. In fact, we will probably see this heat diffuse away. And the coldest place is not going to get any colder. It will probably diffuse away this way. That's what the maximum principle says in this context. What that means, there's an application here, which is that will this ever be bigger than the payoff, which is that? Is this ever going to be bigger than, bigger? Remember the condition to exercise. What was it? We exercise when exercising gives us more than the value. So the question that I have here is, that's the value of exercise. Is that the other way around? Is that ever bigger than that? I want to say strictly bigger. Is that ever bigger than that? That's my question. Is the value ever bigger than the payoff? The thing is that if f is positive for call options, the answer is no, never. Never. That will be against the maximum principle. For puts, it is, but not for calls. This is why when we did trees in the past, because we always looked at call options, we found points of indifference at best. This is the maximum principle at work. That's why it's so hard. Of course, the maximum principle is for diffusion equations. Diffusion equations implies a perfect Brownian motion. We didn't have a perfect Brownian motion. But it was very close. We had a tree that was very close to a Brownian motion. And that's why it's so hard to exercise American call options early, because of the maximum principle. Put options, yes. And by the way, the Black-Scholes equation for American options is the same as European options. There's no early exercise, it's exactly the same. But for put options, yes, it is. And this is something which I'm not going to spend a lot of time on. But for put options, what we have is we have an additional element here. And the element that we have is that the value of the option is never going to be bigger than the exercise. This is what the early exercise option means, is that we add this as a condition to the equation. You may have seen this. This appears very often in elasticity. This is called a free boundary problem. This is what you see in elasticity if you, for example, have the case. I'll try to explain through the video here. If I was in the room, imagine I take a balloon Okay, imagine in my hands there is a balloon. I don't know if I don't have a balloon here. Okay, but imagine a balloon. The shape of the balloon, full of water to make it easier, right? With if I have it full of air, the air is almost weightless. So if I have it full of water, you can calculate the shape of the balloon from the laws of elasticity, which by the way are diffusion equations too. Can you picture the balloon in my hands, everybody? Yeah. Okay, what happens if I take my balloon and I put it against the surface? These equations of elasticity are the same, but I'm introducing a boundary problem. Sorry, a free boundary problem, which is to say the balloon is going to be whatever the equations say, but it's constrained to never go underneath my table. Not going underneath my table is a constraint I add to my PDE, to my partial differential equation. It changes the solution, although the equation is the same. Okay, you may have seen this, especially if you come from engineering. This is the problems that you solve every day. Okay, all right. So this is what we have here. This is a free boundary problem. Think of this as a balloon against the table. I'm saying, well, the balloon will never go underneath the table. So just add it to your equation, and whatever the solution is, which will be different, is what the solution is going to be. For put options, this changes the solution. For call options, no, because our balloon never goes underneath the table. You see what I mean? This is too much. But for those of you who understood this, there's a whole, there are wonderful things that are hiding in that new mountain, which I don't want to climb. I just want to show it to you from a distance, because I want to do other things now. Okay? Again, I want to abandon pricing theory now. And this is somehow the pinnacle of it. There's one more thing, which is the way Black-Scholes formulas are presented to the public are usually not like I did for you. They're presented like this, but okay, so these are formulas, very big formulas. I'm not going to go through the equation. I really don't care for this, but I want you to know that there are ways of expressing these formulas like this, with the cumulative normal, with some factors that go into there and into there. In fact, we're going to use these once in the remaining of this course. These are for call options. For call options. See, when you go back to the example we have here, if this is a call option, this does not have an explicit solution. This integral cannot be solved explicitly. Numerically, yes. Explicitly, no. But you can manipulate it so that using the cumulative normal, you have actually a value given to you there. And there's some accounting interpretation of this. We're going to see this later. This is the value of the liabilities, discounted, blah, blah. No, liabilities, no. It's the value of the strike price, whatever. I'm not interested in this right now. I just want you to know that there are Black-Scholes calculators. You plug in these values and they give you the answer. Well, that's only for call options. Maybe there's another one for put options, but then they don't have an explicit solution because it's a free boundary problem. And there are no explicit solutions for that. You have to use numerical methods. Okay, so I want to leave it at that. Most of these methods are solved with numerical methods. On occasions, there exist explicit formulas. Explicit formulas have use because they allow you to do these calculations quickly, which are great when you try to do Monte Carlo or scenario generator, things like that. But again, now this is many mountains in front of us. I don't want to do anything except just refer to them at this time. What I want to do is I want to stop here this presentation, stop this share, and then show you something which is very cool. All right, let me see what this is. So by the way, many of you, I assume, know Professor John Hall, yes, from Rotman. I assume you know him, yeah? He's one of our most distinguished professors at U of T. Great guy. All right, so he has a book, one of perhaps the most famous book on option pricing. Yes. And with that book, and actually I think this is available on his website, you have a package. It's an Excel macro file that prices options for you. I am sure, well, in fact, I'm sure I know there are other packages that you can download on PyTorch with Python code, and these are wonderful things. But I am, so Kelvin says, I like Hull's options and features. I love it too. It's a great book. Okay. Yes, I agree with you. All right. So there you have, in fact, I think I bought, I don't know what edition I bought many years ago. And this was given to you on a floppy disk, and many of you may not even know what a floppy disk is. So this was in a floppy disk when you buy the book. Now they are, I think they're on his website. You can download this. But I want to use it to tell you some of the additional cool things that the Black Scholes theory has. And one of the advantages of having explicit formulas, and one of the advantages of having a continuous time and continuous asset prices, which is we can bring a lot of mathematical considerations into this analysis. Okay, so I am going to use this as a way to show you other things that go beyond the Black Scholes theory without giving you formulas. Again, very descriptive. My talk today is very descriptive. So I am in the tag that is to calculate equity option futures. I could go into the bond option futures tab, or I can go into caps and swaps, which I discussed earlier, but no, I want to stay here. Okay. If you want to play with the others, go right ahead. You can do it. I'll just show you how this one works. And the way it works is you're going to put you have a certain stock. You have to put the stock price today, 50, that's fine, 50. You have to put the volatility per year. As we know, the volatility is part of the formula. So 40% volatility, that's very high, that's fine. You put the risk-free rate of return 10%. You can put 5, very closer to what we have now. Oops, okay, 5, there you go, all right. And then you can say, well, what is the price of that option? And then you say calculate. Well, sorry, I am having some issues with this. Okay, so I calculate and I get the price. The price is here. The price is here. The price is here. It's 4.50. Okay, that's what the price is. You can do this according to this. This is the analytic European. This is by solving the analytical equation. Okay, we can do other ways. We can do European. I'm not going to get into this. I want to stick with this because my purpose is not to show you pricing, but to show you other things. And this is, oh, by the way, this is a put. If I want to call, that would do that, calculate. Okay. All right. That's a call. Something is going on. Time to exercise. I'm saying that it's half a year. Right? Anyway. I'm less interested in this as I am interested in all of this. What is that? What is that? So let's see. Let's go line by line. The first is price. We know the price. We've been talking about the price for a long time, many months. Okay. Delta. What is the delta? What is the delta? So I think, wait a minute. I think this is the put. So I'm trying to do the call, but it gives me the put. Big deal. No problem. Okay, so I have, it's not working for me very well for some reason. I don't know why. The delta. The delta is the derivative of the price with respect to the value of the underlying. This means if my underlying, instead of being right now 50, is 51, what would the price of this be? Well, according to this, the delta, it says, well, it's going to be 38% lower. Actually, it's going to be 38 cents lower if it's $1 increment. Okay. That tells me that what I'm dealing with is a put, not a call. See, I thought it was a call, but you see, if I do call and I say calculate, I get an error message. You don't see it, but I see it on my computer. The Zoom is not showing you the error message. Something is going on. So it doesn't want to calculate the call price. It only wants to calculate the put price. But I could see that because that's negative. Why is that negative? It's the maximum principle. When I have the payoff equation for a call is like that, right? The derivative is positive. Since the derivative also solves the same differential equation, you would have seen that when you study linear differential equations, then the derivative satisfies the same maximum principle. If my derivative is never negative, the solution of the same equation will also not be negative. That's why this cannot be a call, cannot be a call, cannot be a call. It has to be a put. It has to be a put. You see? This was a job interview question that people used to ask a while ago. Is they give you the price or something and they say, well, the delta is that a call or a put? And then, well, I don't know. Well, yeah, these are the things that you need to know, and these are called sensitivities. Gamma is the second derivative of the price of the option with respect to the underlying. For calls and puts, it's always positive. Why? Again, for the maximal principle, because if that's my payoff, the second derivative is positive. By the way, the second derivative of the put is always also positive. And the second derivative function satisfies the same linear differential equation. Therefore, by the maximal principle, the gamma, the second derivative, must be positive too. That's what it is there. And then there are these other things here. It says vega, theta, rho. Vega is the derivative of the price with respect to volatility. As the volatility gets higher, the price gets higher. Usually, this is what we see this number positive. We expect it to be positive because we know that options are insurance, and if the volatility is higher, the price should be higher, just like every other insurance policy is. You see, but it's reflected here in the first derivative of the price with respect to volatility, called vega. Theta is the derivative of the price with respect to time. And we can see here is that the value is negative, but very, very small. That means that there is very little time change as days go by. This option is almost worth the same. Okay. And rho is the sensitivity of these two interest rates. If interest rate were to change tomorrow, that means that the option will be a little bit cheaper. Okay, so these are sensitivities. All of these, they're called sensitivities. And they are derivatives of the price with respect to the variables that appear in the Black-Scholes equation. You have this described in the top hat book, but these are things which are, again, you can spend a lifetime doing these things, and some people do. They're extremely important when you're doing trades, because you need to understand. This is part of risk management, which is what I'll start with the next time we meet. Okay. These tell you how things will affect your portfolio when things change. So for example, if you have these sensitivities given to you, what you know is that if the stock price goes up, you're going to be hurt quite a bit. So you have a risk. You have directional risk. Okay. The delta is not the gamma is not very big. The delta is very big, negative, but the gamma is not very big, 0.2. That means that you're going to be okay. Crisis creates sudden large movements in stock prices, and the gamma is what directs a lot of your losses. So in this case, you're okay. Why? Because you have an option portfolio. When markets get volatile, your option goes up in value. You're happy, right? There's a typical trade that some people do, which is you short put options on the market. Let me ask you a question. Well, what does that do for you? You short put options. Very out of the money put options, which is that if the market, say the S&P 500 is at, let's say it's at 1,000 now. So I short put options at 500. Well, let me I short put options at 900. The S&P 500 is at 1,000, and I short put options at 900. What does that mean? That means that I collect money. When I sell them, I collect money, and I say, well, the market is never dropping 10%, so I'm fine. I just collect money every day for free, right? Basically, I'm selling insurance. But if that one time that the market drops by 10%, I go broke. Many traders do that. They make money by selling puts, out of the money puts, like 10%, 20%. But if for whatever reason that accident happens, they go broke. They have no money to pay for it, right? This is what the gamma does for you. It describes this type of activity. And in this case, I have no risk. In fact, I can see that if there is volatility, if stocks change a lot, if there's volatility, then I make money. Same thing with the Vega. The Vega is the sensitivity to the volatility. It's the derivative with respect to volatility. So of course, if the market gets more volatile, I'm going to make money. Of course, these are options. Calls or puts, I don't care. Their value increases when volatility increases. And by the way, you can look at the formula. You can look at the formula that we have for the Black-Scholes price. It's not easy. It's not easy, but if you calculate the derivative of that monster with respect to volatility and you're a bit smart, you will see that the answer is positive. But that requires analytical capabilities, which today in the descriptive class I want to give you, I'm not going to do. But I want you to be aware. I'm sure you have done math problems where you have to take the derivative of something with respect to something and prove that the result is positive. Yes, you've done it before. Well, in this case, you could do it with respect to sigma. It's a bit laborious, but you can do it. And some of the other things. Right? So I can see that a portfolio like this is not particularly risky for me unless the stock goes up in price, then I lose money. It's a put. Right? So there is one way of doing risk management, which is to understand these sensitivities and what they do for you. We will see a different way of doing risk management next week. But this also is a good direction to trading. I mentioned to you a while ago that if you are managing a bond portfolio, you want to know the sensitivity of your portfolio to the first derivative, which is what's called the duration. The first derivative, of interest rates, which was the first eigenvalue that you found in your assignment number 1. Okay, that is a delta also. It's a delta. A derivative with respect to a main risk factor, like in this case the underlying security or interest rates, usually is called delta. Except for bonds, it's called duration. It's all part of the same thing. And this is how you start doing trading, by understanding the sensitivities of your portfolio to movements in the market, characterized either by variables or principal components, as you saw in the assignment. Understand this? Okay, and what you have in this graph here is the value of the option with respect to, it's here, right? This is on the vertical axis, the Vega, which is the sensitivity to the volatility. And what you have in the, so here's the sensitivity, that is the Vega. The Vega is like a V, and this is the asset price. Yes, that's what you have there. And then that gives you an idea of how that sensitivity works. But you could change this, and you can say the delta with respect to the asset price. And let's see. Okay, so I get an error. For some reason, my Excel is not working. Okay. I have to say this file is was made for Windows 95 or something. I don't know for what this was made. I don't know. Okay, it doesn't work for me today. So Pedro, yes, your comments are correct. If people care to see them, Pedro, your comments are correct. Okay, so this is something which is not working, which is a pity. I wanted to show you. Asset price, it's all good. Draw graph. There's an error in a hidden module. Something went wrong when I loaded my Excel spreadsheet. Sorry, I cannot show you. It's less important. You can do these changes yourselves. Maybe you can get this to work. If not, you can download some other package from out there. This is a little bit obsolete. For some reason I cannot work with this. But let me then ask you to do one thing. Okay, ask you to do one thing. Download this or an equivalent package. Download this and you play with it. Again, I'm not only asking you to do this. This is not required in the course. This is just for your own good. Okay, and play around with this. But do look at the graph. Do look at the graph and do try to understand what this graph is, given what I told you now. This is not something I can teach. This is something you have to learn. And you learn by doing. Okay? You learn by doing. I don't know if whether today or tomorrow, I forgot, but I had a quiz that I posted on Quarkus. You're gonna get notified of that probably today or tomorrow. I forgot. Okay, I meant it for tomorrow, but I don't know. Maybe I did it today. And there, I want to tell you the question I asked you to do is about the stock, the trades, blah blah blah. It's a call option. I want you. I'm not going to give you the answer. I don't want to. I want you to think about it. But I want you to think about it very, very practically. It may seem that the question that you have is a very theoretical question. It is not. You will realize when you find the answer. It is not. So I do that because I want you to never forget to be practical when it comes to these things. This is not a course where I want you to be academic. There's other opportunities for some of you to be academic in the future. Everything you've learned here should direct you to be very practical. And the quiz that is coming is like that. So my advice is be very practical the minute you start reading it, and then that will help you find the answer. Okay? Okay. So, Chris, are you saying delta approaches 0? That's true. And if delta were negative, then gamma is positive indeed. Got it. Okay, well, that's good because I don't know what you're saying. It looks good. I don't understand. Gamma is the rate of change of delta. Delta matters because delta is what changes in the market will do to your portfolio, right? In a delta negative like this, you're praying that markets go down. You're taking a short position in the markets. You hope markets go down or you lose money, right? However, with the gamma positive, what that means, if markets go up a lot, then you're going to lose more, because not only the delta is you're okay. If markets go up a lot, then the delta will grow, so your risk is going to be less if markets go up. There's going to be a balance between your exposure to the underlying and the fact that you're long volatility because you own an option, right? So with these numbers and negative delta and positive gamma, if the market moves even up by a lot, you're not going to be doing so badly. That's what it means. It's Taylor expansions. You think about this from a Taylor expansion perspective, right? And that's consistent with the positivity of the Vega. If the volatility increases, you'll make money. Of course, you have an option. Is gamma always... No. Gamma, the always opposite sign... No, it's not. If you have a call... What would happen if this is a call option? So exactly what I want you to hear that Excel does not let me. What would the delta be for a call option? Positive. Yes, both delta and gamma are positive, which is why people buy call options. As the markets go up, you make money. You make a lot of money the more up they go, because gamma makes the delta even higher as the market goes up. And that's the value of the option. That's why with 33 cents, you can make $1. Right? You can triple your money, even if the stock goes only up by 100%. Gamma always positive for long call? Yes, gamma is always positive for any option. And by the way, this is a trading strategy which is long volatility. In this case, if you buy and hold an option, you're long volatility. But what some portfolio managers like to do is they like to profit from volatile markets. Very few manage to get it. But investors are looking for managers that are long volatility, that when the markets become crazy, they make money. We will see long volatility strategies when we study trading strategies, which is, I think, is the next to last class. So the second last class, that will be the one that I explain this to you. We'll see how people do that. Okay. And Pedro is asking, so to get this straight, we're approaching the piece price call option price with differentiable functions. No, no. What these sensitivities do is the following. Imagine you have a portfolio, you're a trader. And the market, who knows what's going to do tomorrow, you know? Who knows? So you worry. You want to know that you're not too exposed to movements, and the sensitivities give you that. If the sensitivities are small, your portfolio is fairly hedged. The question is, are you going to make any money? That's a different question, you know? But from a risk management perspective, from trying to understand what the market could do in small changes, these are sensitivities, small changes, today to tomorrow, today to next year, who knows, you know? Sensitivities will not be very helpful there. But in small changes like today to tomorrow, or even throughout the day, intraday, you know, this tells you the risks that you are exposed to in small changes. That's what this does. It's, by the way, it's how traders were doing risk management before risk management existed as risk management. In other words, in the 80s and the 90s, that's how people were doing risk management from this. Then risk management frameworks were created because these don't really work except in small time changes and small increments. And that is the risk management frameworks that I'll be talking about next week, the next time we meet. Okay. So yeah, no, it's not. We're not approaching the call option in a piecewise manner. This is it's like the tangent of a curve, right? You can say, well, I can do a tangent here and a tangent there and a tangent there. Yes, but you don't know where you're going to be. So you know where you are now. You don't know where you're going to be tomorrow. So this is only the sensitivity, it's the tangent to where you are now. Tomorrow you will do this. You will do another one when you move to the next place. But I wouldn't say that's a piecewise linear. You update your sensitivity numbers continuously. And the fact that these things can be calculated so fast means that you can have a system that just reports these sensitivities to you in real time. Okay, Pedro? Clear? All right, good. So I cannot change this, so I run out of things to say. I wanted to... no, none of them change. Something is wrong with the way that Excel was loaded on my computer when I opened it today. It's always worked, just not today. But I think you understand what I'm saying, right? And do me a favor. I mean, I want to stop now. I give you this half hour so you can play with this on your own. It's more valuable if you play with this on your own than if I play it for you, right? After all, that's how you learn to do video games. You have to play them yourself. Okay, so I'm going to leave it there. Any questions? Okay, if there are no questions, then I'll stop here. You get this package or a similar one to work, and do look at the sensitivities. Try to get the curve, not just the numbers, but the curve like we have here. Okay, for the different sensitivities, play with it, get a sense of the results that you get and try to understand them given everything that we saw here today. Everything will be hidden in the Black-Scholes formula that will help you understand the signs and the shapes of the curves that you get when you play this game. Got it? Okay. Class is dismissed then. I will see you in 2 weeks. Have a good reading week. I hope you do a lot of reading. And I will see you February 27 in person. We will see each other in the Sidney Smith building in person on February 27. Okay? Bye now.